Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market update. Let's jump right into the charts and start out with SPY. We had a pretty sharp sell-off on Friday, getting back below some key trend line support around 426. We're going to watch that 413 level pretty closely on SPY, but if we break down below that, still looking at a possible 390 on the SPY for a possible bottom formation. But we want to watch that and see if it develops, but that's the target level we're looking at on the S&P 500 right now is the 390 level for a possible bottom. Taking a look at the NASDAQ, the triple Qs, similar story over here, continued selling pressure quite a bit on Friday as well, and looking for additional selling pressure in the NASDAQ. Really looking at this key Fibonacci support level around 282 as a possible bottom in the NASDAQ. Jumping over the Dow Industrial Averages, same story here, but just a little less selling pressure in the industrial space, but still continued selling pressure and looking for a possible bottom right around the 311, 312 level on the DIA, Dow Industrial Averages. We've been watching the Russell 3000 chart for the last few weeks, or last few months now really. We kind of saw a top formation around the top of this channel, and historically when we see that break down below the 50-week period moving average, then that typically indicates a sell-off down to about the middle of this channel here, and that's about an 8 or 10% drop from where we sit today. So that actually lines up pretty well with the possible bottom at the 390 level on SPY. So we'll be watching for both of these to hopefully line up, and if we can see a bottom form on the Russell 3000 along with the SPY, that might give us a little bit stronger indication that that could be a possible floor, but we're still a ways away from that. Looking at the value line geometric index, we've got about 1,700 stocks in the New York Stock Exchange represented here. Selling off from a key level we had watched at around 630 from 2 weeks ago, and we've seen some pretty aggressive selling broadly in the markets. We did sort of bounce off of this 593 level, so we'll kind of want to watch that closely. If it does bounce and hold support there, we might see actually a little slowing in the market as far as selling pressure, but if we break down below this level, then that would be a strong indication that we're going to see some continued downside pressure. Looking at the VEU, the All World ex-US Index, not looking all that great as well. For about a couple months ago, there were some opportunities that looked like developing in emerging markets relative to the US stocks, but that definitely did not materialize, and it's sold off pretty aggressively over the last 3 weeks or so. That's pretty correlated, I think, with the Russian conflict, and we're just sitting right around the 200-week moving average for support. And so if we can hold that, that might be a fairly bullish signal that maybe the selling pressure outside of the US is subsiding, but if we continue to sell off below this 200-week moving average, then we continue to expect more selling pressure out in the rest of the world. And when we look at the EM divided by the SPY as a ratio chart, similar story. We can see that over the last 3 weeks, emerging markets have really underperformed compared to US stocks. Whereas if we go back a couple months ago, we had about 3 weeks where it actually was very much outperforming US stocks. And so this is a really helpful chart just to kind of get a gauge for if the emerging markets are outperforming the US stocks, but right now that's definitely not the case. Taking a look at the IWB, the large caps, Russell 1000, we've been below the 50-week period moving average for about a month now, and so that's still continuing to look bearish, not seeing a lot of support in large caps right now. And when we jump over to small caps, the Russell 2000, similar story. Been selling off for some time now. We've come up against this support line or resistance line multiple times, and it cannot get above that, and we're also below some key resistance levels here at the 204, 209 level on small caps, and so would expect some continued selling pressure there. And if we do see the IWM sell off some more, possibly this 173.50 level might be a possible bottom, or the 200-week moving average. Either one of those could be our possible bottom that we're looking for in small caps. This is our growth versus value chart. We can see that we've been watching this for a few months now, and really since November. And in November last year is when really the big rotation happened, and so since then value stocks have been outperforming growth. That hasn't changed in recent weeks. Take a look at our RRG graph. I added a few new sectors to it this week. I added the global uranium sector as well as the iClean ETF for clean energy stocks because I wanted to show that relative to the rest of the marketplace. We've seen some real outperformance over the last couple of weeks. in both the uranium sector as well as clean energy. Both of those have had some correlation to the rising oil prices. Basically, the input costs for things like nuclear and other clean energy solutions have not gone up in input costs like oil has recently, and so that's been a bullish signal for those sectors, and we've seen some pretty nice movement in both uranium and clean energy. So if you're looking for some sectors to possibly go long on, those are some good places to look right now. We've also seen metals and mining continue to outperform and really be one of the strongest sectors in the market recently. Energy continues to outperform, obviously, with oil continuing to go up, and gold and silver, while they had a kind of a slower, kind of some selling pressure this last week, overall they still look to be in a pretty bullish trend. So gold and silver is looking like some good spaces to go long as well. The last sector I just want to point out would be the utilities sector. Utilities and consumer staples tend to be good defensive sectors when the markets are selling off. Well, we really haven't seen consumer staples outperform a bunch. Utilities certainly have, and so we've seen some nice opportunities in the utility space. You can take a look at that at ticker XLU. Take a look at the stocks that are in that ETF, and you can find some good long opportunities in the utility sector. Take a look at our oil chart. We had a pretty explosive move in oil over the last couple of weeks. We started out at about $92 a barrel 2 weeks ago. Peaked all the way last week at about $130, and now we've settled back down right around $109, $110 a barrel. And starting this next week coming up, we'll see where oil goes from here. But as long as we're above about $100 a barrel, I continue to expect the long-term outlook on oil to be bullish. And if we're looking at some upside targets, the next couple targets we'll be watching closely are 124 a barrel, as well as 147.50, which was our previous high in the oil markets back in, I think, 2008. If we get above 147.50, then that's when we start looking at possibilities of like 186 or even as much as $200+ per barrel on oil. Not going to be great for the gas pump, but if we continue to see that bullish pressure or bullish movements in oil, then that could be an excellent opportunity to continue to go long in the energy sector and make some money. Commodities, it's been a similar story. Obviously, they're very correlated to energy, with the energy sector being a big chunk of the commodity space. But we've seen the broad commodity sector kind of slow down a little bit this last week as well. Still looking very bullish as we broke out of this long-term trend channel here. And while we might be seeing a brief pause or even a small sell-off in commodities broadly right now, I would expect to see some bullish movement back into the commodity space in the near future. We look at the RC divided by our RHS, that is our consumer staples versus consumer discretionary, and our discretionary has actually outperformed from staples on this last week. So we had a pretty steep sell-off all the way down to about 0.75 on this ratio chart, but then reversed pretty strongly, and we saw a pretty nice movement to the upside. So this last week, people were a little bit less defensive when it comes to consumer staples versus consumer discretionary, but we'll want to watch that. We're just above the 200-week moving average, and we'll want to see if that can hold as support or if we turn around and reverse and head back down lower. Take a look at the high yield corporate bond ETF. We talked about that last week. We were looking at holding support here right around the 8250 level. We wanted to see if that was going to hold or sell off, and as we can see with this weekly candlestick, it definitely broke down further, and now we're down to about just under 81 on the HYG, and so that's also continuing to show us some weakness in the markets. Typically, anytime the HYG is below the period, all the period moving averages on the weekly chart, and that's a pretty negative signal for the markets, and we're looking for continued selling pressure based off of this chart. Also looking at the same chart, dividing it by traditional bonds, and so if we take basically corporate bonds, which are more risky, divide that by more traditional bonds, this gives us a nice ratio chart to see the relationship of risk on and off environment. And really, as we've been chopping around in this channel for quite some time, we broke down 2 weeks ago and continued to sell down even further. And so this is also a strong indication that the markets are looking pretty weak right now. So some interesting developments in the TIPS divided by IEF. So this is Treasury protected bonds versus traditional bonds. Anytime that is looking bullish and going to the upside, then that is telling us that inflation expectations are continuing to rise. And so as we've been kind of chopping around in this channel for quite some time now, these are weekly candlesticks that we've had quite a few months where we've just kind of bouncing around in this channel here. We definitely broke up pretty strong and aggressive this week. well above that ratio chart, and so that's a pretty bullish signal for interest rates to continue to rise. As we jump over to the interest rates, we can see on the US 2-year, we had a pretty strong move this last week. We went from about 1.44% all the way up to about 1.75%. And so that was a pretty big move on the 2-year interest rates. And then our 10-year, similar story. We actually 2 weeks ago went all the way down to about 1.7% on the 10-year. This last week we had a really strong move to the upside, got all the way back up to just about 2%. And it looks like we're just getting ready to start this next week here, just above that 2% level. And then taking a look at our 30-year chart, same story here. All the interest rates, both the 2, 10, and the 30, had a pretty strong move to the upside this week. We went from about 2.12 to almost 2.44% in the 30-year. We're still within this kind of range channel, so we'll want to see if we break out, if we actually see the 30-year break above this 2.45-ish level. That'll be a pretty bullish signal that we're seeing some interest rates continue to rise on the long end as well. And we've been watching the yield curve here, the 10 minus the 2s, watching this really closely as we're getting closer and closer to this zero line. Anytime we get to this zero line, that's a strong indication of a recession coming. We're continuing to see some selling pressure there, and we're at about 0.25 right now on that ratio chart. So we're looking at that very likely to hit the zero line at some point. We're not there yet, so we want to continue to watch that one closely. Saw some really bullish movement out of the dollar over the last few weeks. The DXY about 2 weeks ago was sitting at about 96. We're now sitting at about 99. Looking for continued bullish movement in the dollar. From what we're seeing on the charts here, I would expect at least us getting back to the $100 level on the DXY, and we very well could get up to this 103.85 or even higher on the dollar. Typically when the dollar's going up, that's usually a headwind for stocks, and so it's not a great signal when we're seeing the dollar go up, especially in a rate of change fashion that's fairly quick, and so we'll want to watch that closely as well. Jumping over to the gold sector, we saw some pretty interesting developments this week. As we said, we saw a pretty big sharp pullback after a nice move to the upside. We got all the way up to about 193.40 on the GLD, but then had a pretty sharp pullback, and now we're sitting below a pretty key support level right around 186. And so right now that's going to be acting as resistance for us, so we'd really like to see gold get back up above that level before we probably see the next move higher on gold. Silver really has done well over the last couple of weeks, but it also kind of had a nice move up and then had a bit of a pullback. But over the last couple of weeks, we broke out of this key wedge pattern, and we're moving up to the upside. So if we can see silver close up above this 24.50-ish level, that'll be a pretty bullish signal, and we're going to continue to look for some upside in the silver space. VIX almost got below 30 this week, but we didn't quite get there. We got as low as about 28, 29, but it closed back up on the week. Ended up at about 30.7. So the VIX has been pretty elevated, and that's not surprising. And so we've seen that hold above 30 for quite some time now. And so we're continuing to expect some volatility in the markets. And we'll go ahead and wrap it up with a couple of different sectors that we talked about earlier. This is the iClean chart, ticker ICLN. That's a great ETF to watch. The clean energy space sector. As you can see, we saw some pretty bullish movements over the last few weeks. We were as low as about 17 on the iClean ETF, and we saw about a 20-25% movement in the clean energy space, and so that was a nice move and a nice opportunity to trade some clean energy stocks as oil continues to go up. Similar story over at the URA, which is the uranium ETF. We're sitting at about $19 on the uranium ETF, and then we've seen about a 36% movement since end of January of this year. And so the uranium space is starting to heat up, and looking like there's some opportunities to trade off of that as well. So again, if you're looking for some new sector opportunities to go long on, watch some clean energy stocks or uranium stocks, and there could be some opportunities in the coming weeks in those spaces. Make sure to download the ToroAlerts app on the App Store and utilize our promo code so you can get 1 free month. You can trade both stocks and options with that free promo code, and tune in next week so you can stay in tune with everything that's going on in this volatile market. Thanks for tuning in. We'll see you next week.